Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Have you guys wondered recently, what's going on in the market? Not necessarily the real estate market, just the market in general. There's so much information out there that seems to be, changing all over the place recently. I had one of our clients, I had a couple of my friends who recently have asked me, Ron, I can see what's going on with the stock market. It's all over the place, kind of crazy, which incidentally, that happens in an election season. You get closer, that's probably going to continue to happen. It's going to fluctuate all over the place. Which makes, if you're a stock trader, I guess that's a great thing, right? Any wild swings, if you can figure out what they're doing, well, I guess you can make a whole bunch of money doing that. I am not a stock trader, so I'm not even going to try to help you understand how that works. But I am going to answer the question that they asked me, which is kind of, I feel like we've answered it before on the show, but in the same vein, it feels different right now. The government, look, I've said this before on the show. The government is one of the only entities who can revise their numbers in a negative way, and then the news just goes away. It wasn't very many weeks ago that they revised the number of jobs created down over 800,000 jobs. And it was I think it got reported for, a handful of days, and then no big deal. Now we messed up nearly 1 million, and it's no big deal. But that happens all the time. You see, GDP numbers and all of the numbers that are reported, they're revised typically after the report. The report is given, and then they never actually really, way back in the bottom of what used to be the newspaper, they bury it at the end of the newspaper. They would revise it, but nobody sees it. So all anybody ever remembers is all of this great news that's happening all the time. Okay, well, that stuff is kind of coming out, and when that stuff comes out, especially when you can't hide it, when it's 800,000, that's a big number. You can't hide that one, so that affects what's happening with markets, because those are signs that things aren't quite as good as everybody's making out to be. You couple that on the job scene, you couple that with the fact that the majority of the jobs that the government has touted that they've created are really just jobs that came back post-COVID, and a lot of the other jobs are part-time jobs, and they're not the same jobs that everybody's looking for, right? Okay, so off my tangent. Let's go back to the main issue. The main issue is, why is real estate better than stocks in an unstable market? And the question was specifically about the yield, right? It's about the appreciation or depreciation, right? The gain or loss of money in each one. And my friend was like, look, the stock market and the real estate market have been going up. My point was, hey, look, stock market's been going up like crazy for a long, long time. We're due for a correction. And he said, well, yeah, but haven't we been doing the same thing in the real estate market? Yes, absolutely. We have. And will there be a correction? Yes, at some point there will be. Will it be as bad as 2008? Anybody's guess. Based on history, probably not, but it could be. And so he said, well, what's the difference? Why is there such a difference to you in the two different types of asset classes? Well, first off, the yield comparison, it's not even close, because most people don't buy stocks on option, right? Most people buy stocks for cash from their accounts, whatever account that might be. So if they're buying $50,000 worth of stock, it costs them $50,000, and their yield is whatever it is, 7-8%. their stockbroker will tell them that it's going to be 12, but it's not. It'll be somewhere around like 8%, 7 to 8%, 7 to 9%. And if you don't believe me, just go back and listen to the podcast that I had with Chris Miles, where he explains that. So you compare that yield with the real estate market, when on a nationwide basis, the historic yield is, somewhere between 5 and 7%, depending on who you ask. And so it's not as good. However, nearly everybody buys real estate with a loan, or they leverage real estate. So if you buy real estate with 20% down, you buy a $250,000 house, you put 20% down, that's $50,000. That means you have $50,000 invested, but your gain is leveraged. In other words, you're making your gain on a $250,000 asset, not a $50,000 asset. And that's important because you could lower the yield down to, or the appreciation down to 3%, which is, that's incredibly reasonable, very conservative. And that's a 15% return, 15% yield, because you're leveraged, because $50,000 invested capital controls a $250,000 asset, which is going up at 3%. Okay. And that's what I mean when I said the yield comparison is not even close. Real estate wins every single time, hands down. That's a normal transaction. Buying options, not a normal transaction. Most people do not do that, right? So comparing apples to apples, most people buy real estate this way. So what happens when the markets go down? Well, when the stock market goes down, and this is a really important point, because this is both types of asset classes. When the stock market goes down, people freak out and they sell their stocks, locking in losses permanently. And then they wait for the stock market to go back up before they buy back in. And then they don't even get any of the gains that are on the way back up. It's a very weird phenomenon mentally that happens with stocks. Typically doesn't happen with houses, and that's because there's a corresponding mortgage. Interestingly enough, most people won't sell a property for less than they owe on it. They'll hold on to it. And what allows them to hold on to it? Those of you who have been listening for a long time, you know the answer to this. There's not just one return. Okay. So my buddy's like, yeah, but there's dividend producing stocks too. Okay, that's true. However, dividend producing stocks, typically, they don't have a decent yield or a yield at all. They're typically doing one or the other. And if they're doing both, they're not doing either one of them very well. In real estate, however, both are quite good. If you buy right, both are quite good. And let's just, by good, I mean like call it a 4.5 to 5% cash ROI, which I know some of you listening are like, well, that's not good at all, Ron. Okay, but go with me here for just a second. If we have a $250,000 house and it cash flows a couple $100 a month, that's going to return us somewhere in the neighborhood of like 4.9, call it 5%. Okay. I already told you that we're getting a 15% yield or appreciation return on a 3% appreciation rate. So now we're at 20. And well, that's not everything, right? Because we still have tax benefits and we get to depreciate our property over 27 and a half years. Well, the actual structure of the property, that is a minimum of 3.63%. Okay, so now we're at 23.63%, and we still haven't factored in principal reduction. And I just happened to do a 6.5% interest rate on a $200,000 mortgage, and I looked at the amortization schedule, and if I'm not remembering incorrectly, that's about another 4.8 to 5% return. So now I'm at 28 and some change. Well, okay, so if the property value goes down, I lose the 15% that I was getting. And if my stock goes down, I'm not making any gains there. As a matter of fact, I have losses in both. But the difference is I still have cash flow in my real estate. I still have every single month when I pay that mortgage payment, I'm gaining equity in that property. I still have that. And the government is still allowing me to depreciate that off of my taxes. And I'm not going to pay any taxes on the cash flow that I'm getting. And potentially, depending on your situation, it could be even more than that. And that's not even to suggest that we did a cost segregation study or anything else, right? That's just straight up asset class to asset class. 4 returns versus 1. 2, I guess, if you want to count dividend in the stock. So why is real estate better in an unstable market? Well, because both asset classes go up and down in value. While real estate is not as wild of a swing up and down, they do go up and down. Both of them. But the big difference is there are major returns that are still there. And look, somebody's going to say, yeah, Ron, but cash flow doesn't happen every year either, because sometimes I have a tenant turn and it takes all of my cash flow for the year. Okay, great. So take the 5% away for the cash flow for that year. You still made 8 and change % return in an asset that's not performing very well. That's the reason. Now, there's a whole bunch of other reasons that I've gone over on the show many, many times of why you would buy real estate, but just asset class to asset class, that is why real estate is better. Nothing against the stock market. If you guys are invested in the stock market, that's fantastic. I think both classes need something that is really, really important. And as an annual review with your investment advisor, if you're buying stocks, or with someone in the real estate market who understands investment property, if you own real estate, you should be taking a look and watching what's going on with both. Sometimes we're given a market gift in either one of those. You know, in the stock market, stocks go up tons, really, really fast. Sometimes we just let it ride, and sometimes maybe we shouldn't just let it ride. And the same thing in real estate. Sometimes we have this massive equity spread, and we don't do anything with it when we could be and should be potentially buying more assets with it. I'll do another podcast on that in the coming weeks, but let me end this way. I'm going to do a series on property management coming up. I'm also going to do a series to introduce you to our new tech platform, which is called Lineage. I'm bringing in one or both of my partners and talk a little bit about Lineage. Very, very cool what we're doing there. Some really disruptive things that we're doing in the marketplace. I would also remind everybody that between now and the end of the year, typically people wait until December and they go, oh crap, I didn't buy real estate this year. I need to buy some real estate because of taxes, because there's these great tax benefits. Do not wait. Do not wait until December. Don't do that. It's really, really difficult to close properties if you wait until the month of December, because everybody's gone, including the people who are going to be involved in your transaction. So if you're thinking about, hey, I should probably buy some property, and because I need a tax write-off, and I would prefer to buy property and pay the government, then reach out now. Invest at rpcinvest.com. Invest at rpcinvest.com. If you have something that you would like for us to talk about on the show, please let me know. Invest at rpcinvest.com. We love when people email in. We love doing shows on what you guys want. This entire show is about you. It's for you. So help us build it so that it serves you. And with that, until next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.